This video is for those beginner investors or those who want to get started with stock market investing, but haven't had the chance to do so. Investing is a crucial component of financial planning, offering opportunities to grow wealth and achieve financial goals. A failure to invest condemns you to economic inflation. The stock market, a popular avenue for investment, provides a platform where individuals and institutions can buy and sell ownership shares of publicly traded companies. This video will provide an in-depth guide on how to start investing, covering stock market basics, different investment strategies, and culminating with a case study on Warren Buffett's investment strategy. Overview of the stock market. A stock exchange is a marketplace for the buying and selling of shares, bonds, and securities. Before we get into defining the stock market, let's first understand what stocks are. To skip this section on the stock market, jump forward to the 6 minutes 20 seconds mark to how to start investing. Stocks, also known as equities, are a security representing partial ownership of a publicly traded company. So when you buy shares of stock in a company, it means you own a part of that company, a share being the unit of stock. The more shares you buy, the more stock you have in a company. Stocks are issued by companies to raise money to grow their business. There are two main types of stocks, common stock and preferred stock. The main difference between the two is that common stocks give shareholders the right to vote on company matters and participate in the earnings of the company, while preferred stocks don't. However, preferred shares may come with a higher fixed dividend payout. What is a stock market? In its simplest form, a stock market is a network of stock exchanges where traders and investors buy and sell shares of publicly traded companies. Private companies list shares of their stock on an exchange through a process called an initial public offering or an IPO. Investors purchase those shares, which allows the company to raise money from the public to grow its business. Once the company is listed on a stock exchange, it is now a public company, and investors can buy and sell the company's shares on an exchange which tracks the stock price. The supply and demand helps determine the price for each security at which investors and traders are willing to buy or sell. The stock market serves two important purposes. First, it helps companies raise money by selling shares of securities to the public, which can be used to fund and expand their business. Secondly, it gives an investor, who purchases those shares, an opportunity to have a share in the company's profits. This win-win relational condition sets the foundation for economic growth in a financial market. Investors can profit from owning stocks in one of two ways. Some stocks pay regular amounts of money per share at regular intervals called a dividend. These dividends provide a return on the amount of money invested in the shares. The second way investors profit is through capital appreciation, which is when the price of the stock increases. As mentioned earlier, a stock market is made up of a network of stock exchanges. Stock exchanges can serve as a measure for the health of the national economy and can also be a key indicator of world economic strength. This is because the growth of the financial market equates to higher standards of living and employment rates. Traditionally, stock exchanges were physical buildings in each country of operation. But with the shift toward electronic trading, many have closed their trading floors and switched to online platforms. However, the institutions themselves are still around, and some of them are bigger than ever with market capitalizations of trillions of dollars. As of 2023, there are around 80 major stock exchanges in the world, which are spread across the globe. These exchanges vary in size and trading volume, and some of the largest include New York Stock Exchange, started in 1792, is the largest stock exchange in the world by market cap. Located in the financial district of Lower Manhattan, New York City, has billions of trades daily. NASDAQ, started in 1971, stands for the National Association of Securities Dealers Automated Quotations. That's a mouthful. The NASDAQ is the second largest stock exchange in the world and is focused on high technology companies, also located in New York. London Stock Exchange, or LSE, founded in 1801. The LSE became a leading financial center, facilitating the trading of a wide range of securities. Tokyo Stock Exchange, the largest stock exchange in Japan, founded in 1878. Shanghai Stock Exchange, the fourth largest stock exchange in the world, founded in 1990. Amsterdam Stock Exchange, considered the oldest stock exchange in the world, dating back to 1602. Origin of the stock market. The stock market's origins date back to the 17th century in Amsterdam, where the first official stock exchange was established. The Dutch East India Company issued the first shares, allowing investors to own a part of the company and share in its profits. This revolutionary concept of stock ownership laid the foundation for modern stock markets, enabling businesses to raise capital from a broad base of investors. Major indices. Stock market indices serve as benchmarks to gauge the overall performance of the market or specific segments. The most notable indices include Dow Jones Industrial Average, known as DJIA, comprising 30 large publicly owned companies in the United States. The Dow Jones is one of the oldest and most watched indices. It represents a broad segment of the U.S. economy. S&P 500. This index includes 500 of the largest companies listed on U.S. stock exchanges and is often used as a proxy for the overall stock market. It provides a more comprehensive view of the market compared to the Dow Jones. NASDAQ Composite. Known for its technology-focused listings, the NASDAQ Composite includes over 3,000 stocks and is a key indicator of the tech industry's performance. FTSE 100. Representing the 100 largest companies on the London Stock Exchange, the FTSE 100 is a barometer of the economy in the United Kingdom. Nikkei 225. This index tracks the performance of 225 large publicly traded companies in Japan, reflecting the health of the Japanese economy. How to start investing. Starting to invest can be a daunting task for beginners. However, understanding the basic steps and strategies can help in making informed decisions. Setting financial goals. The first step in investing is to define your financial goals. These can range from saving for retirement, buying a home, funding education, or simply growing your wealth. Clear goals will guide your investment decisions and risk tolerance. Understanding your risk tolerance. Any investment comes with an inherent risk of loss due to movements in the market. The risk can be reduced by lessening the magnitude of the risk taken and good old-fashioned research. Risk tolerance refers to your ability and willingness to endure market volatility and potential losses. It's generally categorized as conservative, moderate, or aggressive. If you have a short-term goal, you may consider a more conservative approach with lower risk investments. For long-term goals, an aggressive approach may be more appropriate with a higher tolerance for market volatility. It is influenced by factors such as age, financial stability, investment horizon, and personal comfort with risk. Generally, younger investors can afford to take more risks due to a longer time horizon, while those nearing retirement might prefer safer investments. Hire a professional manager or broker. For those who are not comfortable with the do-it-yourself model of investing and prefer a more personal approach, an experienced broker or financial is often invaluable. Make sure the advisor has a fiduciary responsibility, meaning they have their client's better interest in mind. These financial professionals tailor their advice to your life experiences and goals, help you decide among the most promising stock choices, monitor your portfolio, and collaborate with you when things need changing. Choosing a brokerage account. The do-it-yourself folks who want to buy and sell stocks, bonds, and funds, you'll need to open a brokerage account. Online brokerage platforms such as Charles Schwab, Fidelity, and Robinhood provide easy access to the stock market with varying features, fees, and tools. Compare these platforms to choose one that best fits your needs. Researching and selecting stocks, buying individual stocks and bonds, is the most complicated and labor-intensive way to invest in the stock market. If you want to go this route, you'll need to learn about researching stocks. Before purchasing stocks, thorough research is essential. Analyze a company's financial health, market position, and growth potential. Key financial statements to review include the income statement, balance sheet, and cash flow statement. Additionally, consider the company's management, industry trends, and competitive landscape. Diversifying your portfolio. Diversification involves spreading your investments across various asset classes and sectors to reduce risk. A well-diversified portfolio might include stocks, bonds, real estate, and mutual funds. This approach helps mitigate the impact of poor performance in any single investment. Investment strategies using the stock market. Investors employ various strategies to achieve their financial goals. When it comes to trading shares on a stock exchange, there are two main types of investing strategies. Day trading, as the name implies, buying and selling the same shares within one day, sometimes making trades that last for just minutes or even seconds. The intent is to take advantage of small fluctuations in price. Then, there are more long-term trades or investments where the buyer holds shares for longer periods of time, and hopes to take advantage of the company's long-term growth in earnings. For those who engage in short-term buying and selling, be sure to understand the tax implications as it pertains to capital gains. Any capital gains made from the sale of securities which are held for less than 12 months are taxed significantly higher than those gains which are held in securities for greater than 12 months. There are plenty of online resources to reference or consult with a tax attorney or a certified public accountant. For those longer-term investors who invest in mutual funds and exchange-traded funds, also known as ETFs, be sure to understand the importance of expense ratios. An ETF is a package consisting of stocks and bonds with varying levels of diversification. Mutual funds and ETFs are easy to manage diversified portfolios in a single fund. Below, we discuss common and lesser-known investment strategies with examples of each. Common investment strategies. Buy and hold. This long-term strategy involves purchasing stocks and holding them for an extended period, regardless of market fluctuations. It is based on the belief that the stock market will generate positive returns over the long run. An example of this is an investor who buys shares of Apple and holds them for 20 years, benefiting from the company's growth and compounding returns. Dividend investing. This strategy focuses on investing in companies that pay regular dividends. Investors seek a steady income stream in addition to potential capital gains. An example of this is investing in dividend aristocrats like Johnson & Johnson or AT&T, which have a history of consistently increasing dividend payments. Value investing, pioneered by Benjamin Graham and popularized by Warren Buffett. Value investing involves conducting careful analysis to determine a stock's valuation, and then buying undervalued stocks that are trading below their intrinsic value. An example of this occurred during the 2008 financial crisis. Value investors purchased shares of banks at a significant discount, anticipating recovery and substantial gains. Growth investing. This strategy targets companies expected to grow at an above-average rate compared to others in the market. Growth investors prioritize capital appreciation over dividends. An example of this is investing in tech companies like Amazon and Tesla, which have shown substantial growth potential. An average 10-year historical performance of a growth investment fund has been approximately 12 to 18%. An example is the ETF NASDAQ 100, which is the ticker QQQ on the NASDAQ exchange. Other known investment strategies. Contrarian investing. Contrarian investors go against prevailing market trends, buying stocks that are out of favor and selling those that are highly popular. An example of this occurred during the dot-com bubble burst. Contrarian investors bought traditional brick-and-mortar companies that were undervalued amidst the tech frenzy. The average 10-year historical performance of a Contrarian investment has been approximately 10 to 14%. An example is the fund FP Crescent Fund, which is the ticker FPACX. Momentum investing. This strategy involves buying stocks that have shown strong price trends and selling those with poor performance. It relies on the premise that stocks in motion tend to stay in motion. An example of this is when an investor might buy stocks of companies with strong upward price momentum, such as Nvidia during a period of technological advancements. The average for a 10-year historical performance of a momentum investment has been approximately 10 to 15%. An example is the ETF iShares MSCI US a momentum factor, which is the ticker MTUM. Swing trading. Swing traders hold stocks for a short period, ranging from a few days to several weeks, aiming to profit from short-term price movements. An example of this is when a trader purchases shares of a company before an expected positive earnings report and sells them shortly after the announcement. The average 10-year historical performance of a swing trade investment has been approximately 6 to 12%. Swing trading is not typically represented by funds and performance varies significantly based on individual strategies. Income investing focuses on generating regular income through dividends and interest payments, often involving a mix of high dividend stocks, bonds, and real estate investment trusts known as REITs. An example of this is an investor who creates a diversified portfolio of dividend-paying stocks, municipal bonds, and REITs to generate a steady income stream during retirement. The average for a 10-year historical performance of an income investment has been approximately 4 to 8%. An example is the Vanguard High Dividend Yield ETF, which is the ticker VYM. Index fund investing is a passive strategy popularized by Warren Buffett, which involves investing in index funds that track major indices like the S&P 500. It offers broad market exposure with low fees. Couple this investing strategy with the buy and hold creates a common long-term strategy. If you're investing in a retirement account such as a 401k or an IRA, then investing in an index fund such as Vanguard S&P 500 ETF known as VOO or Schwab S&P 500 ETF, which is the ticker SPY in your retirement portfolio for over 20 years, could pay off handsomely during retirement. The average for a 10-year historical performance of an index investment has been approximately 10 to 14%. Conclusion: the investment strategy of Warren Buffett. Warren Buffett, often regarded as one of the greatest investors of all time, exemplifies the principles of value investing. His strategy focuses on buying high-quality companies at reasonable prices and holding them for the long term. In 2007, Buffett bet a hedge fund manager, Ted Sage, $1 million that over the course of a decade, a simple S&P 500 index fund would outperform hand-picked hedge funds. Buffett picked the Vanguard 500 index fund Admiral shares, or VFIAX. Sage hand-picked a bucket of 5 funds of funds. A fund of funds is a portfolio of funds that charges 2 layers of management fees. The outcome of the 10-year investment challenge: Buffett triumphed decisively. The S&P 500 index fund Buffett selected delivered a total gain of 125.8% during the decade, while the 5 funds of funds reported gains ranged between 28% and 87.7%. Anyone can replicate Buffett's strategy at a very low cost. The Vanguard Index Fund he picked has an expense ratio of just 0.04%. Conclusion: investing in the stock market offers numerous opportunities to grow wealth, but it requires understanding the basics, setting clear goals, and choosing appropriate strategies. From foundational approaches like buy and hold and dividend investing to more specialized strategies like Contrarian and momentum investing, each method has its unique benefits and risks. By studying successful investors like Warren Buffett, aspiring investors can gain valuable insights into developing their strategies and achieving their financial objectives.